Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
One of the things I've always hated in 30 years of doing this is the phrase, Wall Street's like a roller coaster. And then you get to a week like this where I do get the retail investors' thought that it is like a roller coaster. The first 2 days of trading this week were down aggressively at the open to see stocks fight their way back. I guess we were on day 3 and 4 of the conflict in Iran. On day 5, oil prices went down. We're going to get through this pretty quickly, it looked like. And the stock market went big up. Day 6, oil moves back lower again. The S&P 500 is trading down this morning. It's been trading down all morning. It's accelerating to the point that things will start to slow now as limits are put in. The S&P 500 is down 56 points, down 0.8%, sitting at 6813. The Dow Jones Industrial Average is down 832. That's down 1.7%. Right around 47,907. The Nasdaq's down 110, down 0.5%. Russell 2000 is also down because it's now expected that, well, it's not expected. There's more on Wall Street who expect a war conflict to go on maybe 3, 4, 5 weeks, and that oil will stay high priced, which would likely mean a trickle down that we don't want. And that would be higher gasoline prices, higher manufacturing prices for the input of oil, higher jet fuel prices, higher marine fuel prices. Everything in this world is shipped on a plane or a train or a truck, and they're all tied to oil. I have seen that some company is developing a boat that uses solar power, a big boat too, which seems wise until you get into a situation of, do we have enough solar coverage on that boat to keep it moving across the various oceans? So let's keep moving through some of the higher oil could be higher inflation because of all those inputs. The higher oil could create interest rates that move higher because of inflation. If a food company is shipping oranges from country to country and it costs more money due to the oil costs to get them from the farm to the port to the other port into a truck, the truck, like you see where you're going to see higher prices. And that's the concern. So where are we in oil? That's a really good question. I think that should almost be the first thing I start off with. Brent crude sitting around $85 a barrel, $84.92, up 4.3% today. Gold's lower on a stronger dollar, down 90 basis points, sitting at 5,088. Silver's also lower, giving up 1.5%. 10-year Treasury sits at 4.14%. Wild moves. And the expectation is it's moving higher due to inflation expectations moving higher. Some headlines out there to show you what we're consuming with today. The number 401k millionaires just hit a new high. Broadcom CEO sees AI chip sales topping $100 billion in 2027. Job cut announcements declined last month. Robinhood is launching a platinum card with premium benefits for $695 a year. The benefits are pretty wild. I'll hit that for you in a minute or two. Let me hit the benefits right now. Robinhood is trying to appeal to my children. And that's what makes it an interesting long-term accumulate. Could they grow into the next Schwab or Fidelity? So this $695 price tag on the Robinhood Platinum card, it's got one of the highest annual fees, but you get 10% cash back on hotels and rental cars. That's essentially a 10% cut in price. 5% cash back on flights booked through the Robinhood banking app. 5% cash back on dining. 1% cash back on everything else. That makes it very comparable to the Chase Sapphire card. I'd say maybe even better, because listen to what else you get. You get complimentary Robinhood Gold membership, unlimited Priority Pass airport lounge access, $250 in annual DoorDash credit, complimentary DoorDash membership, $250 credit for autonomous rides, complimentary Amazon One medical membership, complimentary Function Health membership, complimentary Aura membership, $200 annual credit towards health wearable purchases. Robinhood puts the value of those credits at over $3,000. There is a Robinhood Gold card that has no annual fee that earns 3% back on purchases and 5% back on Robinhood travel purchases. So there's options. The card may be a little difficult to get your hands on. It's an invite-only card with plans to expand access in the future. So if you use Robinhood, it seems to make sense because you get 3.35% annual percentage yield on your brokerage cash, 3% match on your IRA contributions, management fees only on the first $100,000 in assets managed by Robinhood Strategies, discounted mortgage rates and a $500 credit towards closing costs with Sage Home Loans. Let's hit some of the daily news, and I've got a lot to get into, as you would probably expect. I did move money from my cash account this weekend into a brokerage account. I have not made any purchases yet. I like being fully visible with you. Transparent as transparent can be. Oil prices are surging higher again today as the conflict in Iran continues. That's the big headline. Broader market mostly lower, particular weakness in defensive sectors. Software names continue to rebound. Walmart was downgraded today to a hold from a buy from a company called Erste Group. That's down 4%. Now that may get a flag for me, like maybe look into that. In large part, I like buying companies that have a very Warren Buffett style to them. Companies that you would want to buy for the rest of your life. Pretend like you only have 20 punches on a punch ticket for stocks that you can buy. Broadcom's up 3.6%, trading higher following its first quarter earnings report. Broadcom's upside versus estimates was not as large as in prior quarters, but investors appear focused on the company's powerful second quarter outlook and an accelerating AI trajectory. Guidance points to a meaningful ramp in both semiconductor and AI-related revenue, led by custom accelerators and network products. When I say network products, I'm talking networking products. So the morning trade starts with the phrase, oh, oil prices are moving higher again. And as you see oil prices move higher, you'll see markets move lower. Broadcom impressed with its earnings results. There's not much else to say today as far as the two big movers of the market. There was a little bit of economic data. Non-farm business sector labor productivity increased 2.8% in the fourth quarter, following an upwardly revised 5.2% in the third quarter. Unit labor costs jumped 2.8% in the fourth quarter on the heels of an upwardly revised 1.8% decline. Key takeaway is that we have, with the initial jobless claims numbers, 213,000 for the week. Continuing jobless claims increased 46,000, 1.86 million. A labor market that's slow to fire employees right now, unless you're tied to a Jack Dorsey company. I think before we get into the individual headlines, it's good to focus on oil. History suggests investors should pay more attention to global crude levels than to war headlines. If you go back to the Middle East conflicts, stocks tend to bottom the same day that oil prices peak, suggesting that energy markets are the clearest signal for an inflection in stocks. That's not to say that the turmoil is over. Missiles are still flying. But yesterday when oil inched lower, stocks bounced back, thinking that maybe we hit peak. When Iraq invaded Kuwait in August of 1990, crude prices skyrocketed and stocks fell sharply. Investors repositioned for the economic fallout of higher energy costs. Higher energy costs eventually hit the U.S. economy, especially hard for middle class and lower income. Can Trump afford that to happen when we're 7 months out from an election? And I say Trump because his administration is pulling off this conflict without the representation of Congress. So it's going to fall squarely on Republicans until it gets expanded and gets congressional approval. A lot of people are quite frustrated that Americans can spend billions on missiles to hit Iran and to take out a nasty regime that has not been West-friendly, a very tough regime to negotiate with, a very closed country, spending billions there when we're cutting social programs in the United States, including doctors for Veterans Administration, food delivery for the elderly, healthcare for the poor. A lot going on. During periods of widespread military conflict, oil prices and equities trade in virtual lockstep. Now, I know that the geopolitics of the Middle East are complex. I grew up with a father in the military. I lived in Iran for a short period of time until we were forced to leave due to the Shah of Iran being overthrown, put into exile. I lived in Turkey. I lived in Germany. I lived in Japan. I don't pretend to be a geopolitical expert because I'm not. I just know Iran is a very difficult nut to crack. When the cost of energy spikes, it's taken as a tax on consumers, sapping discretionary spending and fueling recession fears. Once that momentum reverses, it's like breaking of a fever. Markets can suddenly look past the fog of war to focus on the earnings and fundamentals. Year to date, crude oil, Brent crude's up 35%, silver's up 19%, gold's up 20%. I weirdly said oil was my pick of the year, along with Amazon. So one I hit a home run on, one I've done a miss. I might pick up some Amazon this week. I might not. The Morgan Stanley Country Index, all world, is up 1.7%. The Russell 2000 is up 5%. And then you get nothing out of the S&P 500. It's less than 1%. Dow Jones Industrial Average less than 1%. The Nasdaq's negative 1.8%. 15% global tariffs start this week. That's another tax on the U.S. consumer, especially in the middle class and the lower incomes of America. It's believed that about 90% of the tariffs get passed on to U.S. consumers and corporations. There's lawsuits from companies like Costco to get refunds from the tariffs last year that the Supreme Court ruled illegal. Trump administration's trying not to pay them or delaying as long as possible. That will push up bond rates. Bitcoin soared 9% yesterday, hitting its highest level since February 4th. I forgot to look at Bitcoin when I was giving you the market numbers. Shame on me. Bad, Rob. Let's take a look at Bitcoin's down $1,400 today, down 2% to 71,628. Amazon is launching an AI-enabled platform to automate healthcare administrative tasks. The agentic AI-led platform called Amazon Connect Health integrates with electronic health records that clinicians use for patient verification, appointment scheduling, compiling medical histories, clinical documentation, and medical coding. It's designed to operate around the clock, booking appointments instantly and escalating complex cases to staff as needed. The platform undergoes multi-step evaluation of model performance for safety and accuracy, including clinician-in-the-loop driven checks. Amazon Web Services said UC San Diego Health, which has deployed the tool, has reported saving 1 minute per call and reducing call abandonment rates by up to 60%. The system can transcribe doctor-patient conversations during visits, draft clinical notes for providers in real time to review, and generate patient-friendly summaries. I went to the doctor last year to get my physical. She sent me out with 4 or 5 appointments to make, of which I only caught on to 2 of them because the paperwork was so sloppy. From my perspective, I love the idea of Amazon AI and web services getting in and helping doctors because it's a industry that's a bit of a mess, paperwork-wise. Now, do I like the idea? That's probably going to take some administrative work away from people. That may mean loss of jobs, maybe more profit for the doctor's office. In other AI news today, Netflix is acquiring Ben Affleck's AI film tech firm. Financial terms not disclosed, but Netflix just walked away from their deal to acquire Warner Brothers Discovery, and they get almost $3 billion just to walk away. Ben Affleck, founded Interpositive in 2022 by creating an AI model trained to understand visual logic and editorial consistency while maintaining cinematic rules under real-world production challenges, such as missing shots or incorrect lighting. Amazon plans to use AI to speed up TV and film production. More jobs in the union. There used to be a lighting specialist, for instance. Now Amazon and Netflix are both, I don't want to use the word quickly, but they're both having no problems because they aren't studios that have the big issues with unions and union agreements. An oil tanker logjam is now driving up energy prices again today. There's rumors out there that an oil tanker was struck by Iran. In other news, Anthropic has reopened talks with the Pentagon about using AI models for the Pentagon. President Donald Trump on Friday ordered every U.S. government agency to immediately cease using technology from Anthropic. Several defense companies followed suit by telling employees to stop using its Claude AI assistant. Broadcom's up today, painting a very upbeat picture about the future of custom chip business. The guidance points to a meaningful ramp in both semiconductor and AI-related revenue led by custom accelerators and networking products. Visibility now is extending to over $100 billion in AI chip revenue by 2027. That ambitious target, combined with expanding hyperscaler partnerships and improving supply chain visibility, is helping reinforce the bullish narrative around Broadcom's position at the center of AI infrastructure build-out. CoreWeave was hit with a sell rating today. This is exactly what Wall Street does not want. The firm says, Bernstein says, hyperscalers will not be incentivized to sign large contracts to rent its hardware. They want cloud adjacencies. And CoreWeave has a lot of debt. That debt is what scares me away from it. Another company playing the debt game / AI game is IREN, IREN. They unveiled a plan to sell as much as $6 billion in stock. That stock got hit 9% today. They said they're going to use the cash from a potential sale of new shares to contribute to funding our growth initiatives, including but not limited to hardware purchases and acquisition and development of data center sites and facilities. American Eagle, Machi Mat. You know why I'm doing that, right? Sydney Sweeney. Their stock's down 12%. They had a pretty good quarter. Strong fourth quarter performance, accelerating sales trends, and expanding operating margins. Stock sell-off reflects investor concerns around the near-term earnings cadence. Management's guidance implies significant first-half pressure from tariffs and stepped-up marketing investments, which will suppress profitability even as sales remain healthy. The widening gap between the high-growth business of the Aerie offline and the slower-growing American Eagle brand underscores a transition period for the company's portfolio. I don't own any American Eagle, but I think the whole idea of watching Sydney Sweeney and the Kelsey brother who has a line with them teaches you about marketing. And that Wall Street's really all about product. American Eagle said its partnership with Sydney Sweeney and Travis Kelsey had garnered more than 44 billion impressions. The retailer hit meme stock status last July when it initially launched its Sydney Sweeney Has Great Jeans campaign. American Eagle shares have climbed 120% since the Sweeney ad first landed. Let's take a break here. It's a good place. I'll prepare some TV notes, and I'll be right back with market updates and more stories for the day.
These days, retirement planning is more complicated than ever. So set aside Wednesday evening, March 11th, and get ready to learn some strategies for navigating wealth in uncertain times from Stephanie Richman, Rob Black, and Nathan Rogers. This event will focus on retirement income, tax strategies, estate planning, and tax planning. If you're at or near retirement with at least $500K in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves, Social Security strategies, and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. That's Wednesday, March 11th, 6:30 p.m. at the Lafayette Library in Lafayette. Space is limited, so sign up today at robblackshow.com. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Keeping up with the headlines, the NASDAQ is down essentially at the low for the day, 60 basis points, down 138 points. The Dow is essentially at a low for the day, down 871, so no snapback yet. That's down 1.8%. And the S&P 500 falls into the same classification, down 90 basis points. Down 60 points overall, sitting at 68.08. The Dow for the year is flat. The Nasdaq's down about 2%. The S&P 500 down about 1%. So we're not down 10%. We're not in a correction. We're not in a 20% bear market. With that said, it doesn't feel good either, does it? Because we were starting to make some nice momentum on the Russell 2000 and areas outside of the Magnificent Seven. Scanning the news to see if there's any breaking information as I'm putting together the last report. I guess we could talk energy sector. That looks compelling. So the S&P 500 is down about 0.9% today, but the energy sector's higher. There's support for energy with the rising price of oil. Oil's climbing and persistent worries about the potential for some supply interruptions, which are prompting countries to ensure ample reserves. Overnight, China reportedly ordered its top refiners to suspend exports of refined fuels. Continuation of a strong start to 2026 with four components hitting fresh 52-week highs in the sector that I'm looking at. EOG Resources up 3%, hitting its best level since February 2025. Apache, ticker symbol APA, best performer in the sector. It's looking for its best close since April of 2024. Phillips 66, ticker symbol PSX, moving towards a record high from 2024. Valero, ticker symbol VLO, they're rising to a fresh record high. Chevron, ticker symbol CVX, is on the verge of a fresh record close. And one more, Marathon Petroleum, ticker symbol MPC, it's rising to a fresh record high. I don't like civil wars when it comes to investing. And what I mean on that is Flutter Entertainment. They are the company behind FanDuel Sports. Their president, Mike Raffensperger, is going to depart amid rising prediction market competition, according to Sportico. And when I'm talking competition here, what I'm really talking about is prediction markets versus betting markets. Betting apps aren't legal in every state. Prediction markets are. Well, it's a fine line to say that they're legal, and some attorney generals are trying to stop them. Grocery outlets having an awful day. You'd think that Grocery Outlet, which is a discount retailer, would be doing better with the consumer. They're more of a mid-consumer to lower-end consumer. A lot of factors behind their weaker performance. Grocery Outlet said consumer pressure intensified throughout the quarter. The environment turned more promotional and it missed on value perception as supply chain execution shifted the mix away from the higher impact opportunistic deals. They're doing store refreshes right now. They're closing underperforming locations. Not my kind of investment. I have a big event coming up March 11th, less than a week from today. What great timing, no? Are you in retirement? Are you concerned about the markets correcting 20%? Would your retirement be okay? Do you have a financial plan? Do you have a financial planner who can help you identify areas of inflation, interest rate problems, products that are bad, like annuities? Most annuities are not good for you, the consumer. They're good for the person who sells them to you. But on top of it, long, short funds and much, much more. You can sign up for the event. It's a wealth preservation and retirement planning event. Wednesday, 6:30 to 8:30 in Lafayette. I'll be there. 2 financial planners giving presentations. It's fun. It's social. It's insightful. Plus, you get a free preliminary plan after the event where we'll tell you how you're doing. Better than anyone else in the sense that it'll be an honest opinion. Now back to the stock market. Sign up at robblackshow.com. Bank of America reinstated coverage of fintech and payment stocks of Visa and MasterCard, Block, Affirm, and Klarna with buy ratings. For most of my life, Visa and MasterCard have been buy-rated stocks. I'm not a big buy now, pay later person. I have a hang-up, and I probably won't be eyeballing it terribly much. JP Morgan raised their price target on Target to 120 from 115. Target is overhauling some of its lagging categories, such as home decor, as it tries to win back both shoppers and investors. Citibank lowered the price target on CrowdStrike to 525 from 610 after respectable quarterly numbers this week. It's a pretty good quarter. They exceeded expectations, but because it's software, and in theory, this time next year we'll be able to ask Claude, hey Claude, that's Anthropic's AI model, make me software security that stops intrusions on all my employees' desktops. And in theory, it's going to be able to do that software. Most in the industry don't believe it, but there will be some disruptions, and there will be probably longer-term, lower contracts in the software space due to AI agents building software. But there will be winners and losers as well. JP Morgan took StubHub to a hold from buy. Wow, what a bad stock. They came public this year, and it's done nothing but go lower. Wedbush downgraded the stock to a hold, citing limited conviction and visibility into StubHub's direct issuance business. Taylor Swift isn't in concert right now. That's probably having an effect. Stock's down 15%. Posted a loss of $1.56 a share, significantly worse than the 1 penny loss per share that analysts expected. They were supposed to book $449 million in revenue. Well, they were supposed to book $485 million. They booked $449 million. So it's that about $26 million difference. $36 million difference. Gross merchandise sales reached $2.3 billion in the quarter. StubHub pointed out that would have represented a 6% year-over-year growth, excluding the impact of Taylor Swift Eras Tour. Can you imagine? She's so king of the hill that you have to try to work around her when she's not there. Earlier this month, lawmakers in both New York and California, two of the world's largest live music markets, introduced legislation that would cap concert ticket resale prices to the ticket's original face value. That would be a death to StubHub if that caught on. Can't imagine that it can. Staying in the world of media, Paramount Skydance CEO David Ellison got on CNBC this morning and he said the Warner Brothers deal is great for the company, the consumer, and the overall economy. What would you expect him to say? He says the company is in great position in the streaming and content space. Combined subscribers will go down a bit due to overlap. There will be $3 billion in synergies when the deal closes. The company will ensure its investment grade 3 years after closing. It's junk debt now, or close to it. They believe the company has the cash flow to manage the debt. CBS has 8 out of the top 10 shows on broadcast television. I can't name a single one of them. That's the problem. The people who are watching CBS are older than me, and I'm old. David Ellison said the transaction will be a positive for CBS News and CNN. I have some doubts on that. Cynical Rob Black says something along the lines of, okay, Twitter's owned by a billionaire who spent something like $300 million on past elections. CBS is now going to be owned by a billionaire. CNN is going to be owned by a billionaire. Then you look at some of the other media properties. Fox, owned by a billionaire. And the Washington Post, owned by a billionaire. All Republicans. Cynical me would like journalism not to have a bias. I myself am a big fan of Bloomberg Television and Bloomberg Radio, as well as the BBC for getting my world headline news. At least I think it's coming from in Europe. The BBC is considered just pristine news. And in the United States, I think Bloomberg tries to come at everything from a financial angle, which, hey, I'm in that world. So back to David Ellison. He said the company plans to continue its relationship with the NFL, although they might change some of the deals that Warner Brothers Discovery did with the NBA and some other sports packages. HBO Max and Paramount Plus will absolutely be put together under the same application. David Ellison doesn't have anything to share on pricing at this time. Now, I told you earlier, Netflix announced the acquisition of Interpositive, the filmmaking technology company founded by Ben Affleck that develops AI-powered tools built by and for filmmakers. Interesting. I think Netflix is the big winner of that Warner Brothers Paramount disastrous merger acquisition. I just think Paramount Skydance has taken on too much debt. NVIDIA has reportedly halted production of the H200 chips for sale to China in favor of a Vera Rubin ramp-up. That's big news this morning. Selling H200s to China is proving more difficult than NVIDIA had anticipated. The Financial Times reports that the chip designer has asked Taiwan Semiconductor Manufacturing to stop output of the H200 processors and instead produce Vera Rubin offerings. That's their upcoming flagship edition. There's a lot of conviction that mega-cap tech companies outside of China will appreciate any supply boost for these next-generation processors that the U.S.-China trade and regulatory morass has gotten complicated with the H200 in China relationship. NVIDIA had H200s in inventory. They've already produced 250,000 of those chips, so the sales opportunity is still there. It's just diminished going forward. The history is that even though things are loosening in China, it's still tough. NVIDIA wanted to sell AI chips to China back in December. The U.S. President Donald J. Trump said this would be allowed for the H200, a generation that was much more powerful than the China produced domestically, but not cutting-edge technology in the U.S. and Western markets. NVIDIA calling on Taiwan Semiconductor to increase production of chips saw a sales opportunity as high as $54 billion in 2026. China wants their own companies to purchase from domestic producers to reduce their dependence on the U.S. technology. We do not want China to beat us in AI. Trade Desk got a big giant insider buy. CEO Jeff Green purchased about $150 million worth of the stock. OpenAI has had early talks with Trade Desk about selling ads, pushing shares up. Today, stock has been crushed recently on competition concerns. Again, I don't like civil wars, and this is too much of a battle where you get Trade Desk against Amazon and Alphabet and others. OpenAI will initially use external partners to sell ads and scale up its business, having launched ads on ChatGPT just last month. Sam Altman's company OpenAI is reportedly planning to bring ad tech functions in-house eventually, including automating sales and offering performance information to advertisers. The Magnificent Seven trade, it's fizzling out. Alphabet, Amazon, Apple, Meta, NVIDIA, Microsoft, and Tesla. Investors don't want companies with high PEs, even though Microsoft and Amazon and Apple now have competitive price offerings. Competitive valuations with the S&P 500 based on next year's numbers. I can make a case for some of these stocks as initial positions or as trades, but I don't want you to get caught up and you have to own many of them, or you have to own only them. Bank of America securities analyst Michael Hartnett coined the term Magnificent Seven back in 2023, referring to the 1960s Western gunslinger flick, which was an adaptation of Akira Kurosawa's 1954 film, Seven Samurai. Both really good movies. I don't know how they've held up, though. Both movies I watched in the late 90s, probably. People are predicting the era of these titans as potentially fading. Back in the 1960s, when 10 companies led by AT&T, General Motors, ExxonMobil, back then it was called Standard Oil, they accounted for nearly 30% of the market. The Nifty 50 in the late 1960s and the early 70s in the dot-com era, when mega tech stocks like Cisco, Microsoft, Intel, and Dell made up 27% of the market. Some analysts are seeing saturation. It's bigger money, though. Hyperscalers are set to spend $670 billion in CapEx in 2026, up from $410 billion in 2025 and $240 billion in 2024. A recent paper was written that says AI will kill the tech monopolies. Some of these big giants have historically generated profits from three sources: economies of scale, network effects, and proprietary technologies. A lot of things that the Mag 7 have enjoyed that have contributed to their profitability could now be threatened by AI. First, to think about is AI subverts the tech giants' economies of scale by lowering the relatively high fixed cost of writing software, which has served as a protective moat for these companies. AI allows anyone to code, and the market has brutally punished software companies with the iShares tech software exchange traded fund down 30% from its 2025 peaks. The network effects, which have greatly facilitated the likes of Facebook, YouTube, and LinkedIn. AI is undermining this advantage in two key ways. AI bots populate these sites with fake images and get rich schemes. Audience tune out. And another reason is the even more concerning for the networks is that AI systems could create a content feed layered on top of one's preferred social media. This would reduce the leverage that, say, YouTube has over an influencer who could bypass that channel and post anywhere and get picked up by the AI algorithm. Less than a week to sign up for the March 11th event in Lafayette. Sign up at robblackshow.com at 6:30 to 8:30. I'll get there around 5. If anyone wants to grab a drink before, maybe an appetizer, let me know and we can make that arrangement. You can sign up for the event. It's Wealth Preservation Retirement Planning, 6:30 to 8:30 in Lafayette. You'll be home by 9. And great parking, easy parking at the location. Bring in 2 CFPs, maybe 3 CFPs with me. All questions will be answered. We'll offer you a financial plan afterwards, absolutely free. Take me up on that one. It's a good one to see how you're doing well and what you're doing wrong in your portfolio. Sign up at robblackshow.com. That's robblackshow.com.
Retirement planning is more complicated than ever, and it can be hard to even know where to begin. So set aside March 11th, Wednesday evening, 6:30 p.m., and get ready to learn some strategies from Stephanie Richman, Rob Black, and Nathan Rogers that can help you retire better and pass on your estate while navigating wealth in uncertain times. That's March 11th at the Lafayette Library in Lafayette. The event runs from 6:30 to 8:30 and will focus on retirement income, tax strategies, estate planning, and tax planning. If you're nearing or you're now in retirement and have at least $500,000 in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves. Also, Social Security strategies and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. Navigating wealth in uncertain times is appropriate for individuals with at least $500,000 and either in or heading to retirement. Wednesday, March 11th, 6:30 to 8:30 at the Lafayette Library in Lafayette. Sign up for the event at robblackshow.com.